welcome to this session in which we would look at fraud auditing, which is part of the cash cycle. So in this session, we're going to be auditing cash, but specifically we're going to be auditing from a fraud perspective. When we suspect fraud is taking place, what do we have to do? So this session is part of the broader cash cycle that we learned about so far, which is we looked at the introduction of the audit cycle for cash. We looked at internal controls and specifically bank reconciliation. And why specifically bank reconciliation? Because all the internal control for the cash, other than the bank reconciliation, are covered in the various cycles. So as we covered revenue cycle, we looked at cash. As we covered the expenditure cycle, we looked at cash. The only thing new in this cycle that we looked at as a form of internal control is the bank reconciliation. We also looked at the bank confirmation, and we looked at the importance of the cutoff statement in the prior session. And those were the tools or the resources or the evidence that we use as we are auditing the bank reconciliation. So we looked at how we audit cash, generally speaking. Today we're going to focus on fraud-oriented procedures related to cash. So it's not just cash, it's when we suspect fraud. So we'll dive into this. We would look at tools that we have on our hands. Now, it's very important before we proceed that you know what a bank reconciliation is, because we're going to go back and dive deeper, literally dive deeper into the bank reconciliation. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our audit course is best for online students and students who are struggling in their audit courses. We cover the essentials from audit reports, internal control, ethics, evidence, sampling, planning and materiality, assurance and non-assurance services, and of course, the accounting cycles. Our comprehensive course includes lectures, multiple choice, true-false questions. Go ahead and start your free trial today. We are here to help. Your success starts here.
The first thing I am going to do is make the case why is fraud risk high with cash. And it's easy case, nevertheless, I have to make the case. So why is cash susceptible to fraud? I always do this when I'm in the classroom. I offer, when I cover the session, I offer, usually I'll have a calculator. So students will have a calculator in front of them. And that calculator, if it's a TI calculator, it could be worth up to $100. And usually I will have $20 in my wallet, and I will say, okay, here we go. I'm going to give you two options. If you can steal one of these two things, and often students basically they choose not to answer, but I insist. If you can steal this calculator that's worth $100, or if you could steal this $20 right now, $20 bill, which one would you steal? And again, many students refuse to answer the question, but there's a point to that exercise. And at the end, most students, they would say, I want the $20. And I would say, how come you want the $20? The calculator is worth $100. And the reason why they want the $20, they will prefer the $20 because it is liquid and easily misappropriated. It's a piece of paper they can put in their pocket, and it's not identified. You cannot put your name on it or anything like that. And it's liquid, readily accessible, easily concealed, and hard to trace once stolen. Also, they can go down to the cafeteria and immediately buy a pizza and a cup of coffee with that money, and a sandwich. With the calculator, they have to sell it. And as they sell it, they might be uncovered because the person's name might be on it. So it's not easy to conceal the calculator, but it's easy to conceal the cash because it's not identified. Because of these characteristics for cash, auditor must be vigilant when evaluating the risk of fraud involving cash. So that's why cash is a high risk, because it's liquid, easily misappropriated, easily concealed, and liquid. We can use it immediately. So when do we expand audit procedures for cash? So at some point, the auditor would say, you know what, let's do a little bit more of work. Well, the first signal is we have a weakness in internal control. Now, these weaknesses may not be specific to cash, but they also be related to cash functions like cash receipts, cash disbursement, payroll processing, because remember, all cycles somehow touches upon cash. So since cash touches every cycle, any breakdown in internal control should do what? Heighten our risk of material fraud. But what are some of the key risk factors for cash is if we have weak or non-existing internal control. Obviously, if you have non-existent internal control, it should be a red flag. We need to look at cash more closely. Poor segregation of duties or poor separation of duties. One person handling everything. The receipts, the deposit, the bank reconciliation, it's a problem. Manual processes or missing documentation. We're not finding certain documentation and nothing is automated, manual. We have high turnover of employees or management overriding the system. We notice that employees don't last there very long, or management always override the system. Whatever internal control we have, they kind of ignore it to get the company running. So when auditor finds those weak control in any area related to cash, now it's time to dig deeper. So what they will do, they will extend their audit procedures and they use tools to catch the fraud that otherwise could go unnoticed. So a good audit is not to just check the math, check the figures. We want to ask, what can be hidden? How can they hide a theft here? And be in the shoes of the perpetrator. So now we're going to look, now we know when do we expand our search. Now we need to take a look at what tools do we have in our arsenal to focus on auditing cash from a fraud perspective. Well, the first thing we can do is we can do an extended test of bank reconciliation. Remember at the beginning I said we will look at the bank reconciliation again, but now we're going to look a little bit closer. Extended test of the bank reconciliation. We're going to verify the legitimacy of reconciling item over multiple period. So we're not going to look at one period, we're going to look at multiple period. We were going to what we called proof of cash, which is a reconciliation that ties together the beginning and ending cash balance, receipts, and disbursement to highlight any unrecorded or missing transaction. That's the second tool. And the third tool we might use is the test of interbank transfer, evaluating the timing of recording of fund transfer between account to detect manipulation, and here we're looking at kiting. So those are the three tools that we have. We're going to look at each one of them a little bit more in depth. So each one of them will enhance the audit assurance and uncover potential fraudulent activity when internal control are unreliable and absent. If everything looks good, just the bank reconciliation, what we did in the prior session, will suffice. If not, we have to extend the test of the bank reconciliation. Remember, the bank reconciliation is reconciling the cash record to the bank. Remember, we have two sides. We have the bank and we have the books. And at the end, they should equal to each other after we account for everything. So it's a safety check to make sure what the company thinks it has matches with what the bank says. So the books, the general ledger, and the bank, they reconcile, they equal to each other. So if the auditors suspect fraud or manipulation, they don't stop at a quick review. Now they're going to dig deeper into this bank reconciliation. So what are some of the step-by-step processes for extended bank reconciliation test? We're still going to do the bank reconciliation, just we're going to look a little bit deeper. We're going to use more than a month. So we're going to start with the prior month reconciliation. So if we are preparing the December 31st monthly, we're going to start with November. We're going to go back to November, start with the prior month, get a list of checks and deposit that hadn't cleared yet. So what was outstanding in November? Look at those closely. Check that all these that were outstanding in November, they cleared in December. Now, if we're preparing a normal regular bank reconciliation, we don't dig that deeper. We assume whatever was outstanding is cleared. Now we're going to look a little bit further. If any were not cleared, we need to find out why. What I'm saying is this: if I deposited something by the end of November and it's not appearing in December, was this really a legitimate deposit? If I wrote a check in November and it hasn't cleared yet by the end of December, why? Why? Was this just an actual check? Or did I write the check, recorded the check, and I never mailed it? What's going on here? We need to match canceled checks and deposit slips from December bank statement to the company record. Now we're looking at everything a little bit more closely. Make sure that every outgoing check and deposit show up in the books. Now we're looking at every single thing. So traced any uncleared items from November reconciliation and December journal entry to December 31st reconciliation. Now we're accounting for everything November and December, and verify that every leftover item is accounted for. Now we're looking at everything, every single item, make sure is it accounted for, whether it's in November or December. We're going to inspect all reconciling item in the December 31st reconciliation. Now we would look at every item a little bit more in depth, confirm they are either outstanding from before or from the new transaction in December, but they have not cleared yet. Which is which? We need to look at why they haven't cleared yet, for what purpose this check was written, was there a legitimate business reason, so on and so forth. So this process checks for intentional misstatement, like hiding checks or recording deposit that haven't really gone through yet. So that's what we want to do. It's about making sure every single transaction is recorded properly. Now we're looking at every single one, and no gaps or fraud can be hidden. So that's what we mean by extended bank reconciliation, looking at the reconciliation a little bit closer. And notice this takes me back in memory lane, because when I was in practice, and I always say we prepared many bank reconciliation, every time we had an error, some sort of an error where the bank reconciliation does not reconcile, we had to go through this process. So it's not only looking for fraud, also an extended bank reconciliation is used when there's an error or when the books are not properly prepared. There's a lot of mistakes and you have to look for the mistake. Then you have to examine every single transaction, literally every single transaction. That's one thing. Another method is something called proof of cash. This is missing cash or extra transaction. So when the company has weak control over cash, an auditor may perform what's called the proof of cash. This test compares what's recorded in the books versus what actually happened in the bank statement throughout a period of time. Now we may take 3 months or 6 months and account for everything. Think of proof of cash as a two-way street. We're going to go from the books to the bank. Every single cash receipts recorded in the ledger should show up as a deposit. Now we're looking at every single one by one. And from the bank to the books, every bank deposit should have a matching entry. But now we're doing it for a longer period of time. The same logic applies to cash disbursement, money out. Each payment recorded must actually clear the bank, and every bank withdrawal or outgoing payment must be on the books. Basically, looks like a bank reconciliation, but it's for a longer period. So a proof of cash report usually has columns for starting cash balance, receipts, disbursement, and ending. And we're going to have adjustments. We're going to adjustments for each period, such as deposit and transit or outstanding checks if we have any. So both the book and the bank sides are adjusted for timing differences. So after accounting for these changes, everything should match. So it looks something like this. Per books, we have a beginning balance, receipts, disbursement, ending balance. Per bank, same thing. What was the beginning balance, receipt, disbursement, and ending balance? So what we're looking for, once adjustments, we have adjustments, timing adjustments are made, both sides should line up. If they don't, the company could be hiding receipts, missing payments, or misappropriating cash. So proof of cash is usually performed over a whole year or for a specific period, could be a quarterly. So it catches fraud like skimming, receiving money but not recording it, or paying personal expenses with company funds and leaving them off the ledger. This is what you're trying to find out. So first, let's take a look at a bank reconciliation, then look at a proof of cash. And for our purposes, a June 30th X3, a bank reconciliation, we have the bank balance starting at $12,950 plus deposit minus outstanding checks will give us the adjusted bank balance. The balance per books $14,250 plus interest, that's the only thing we had, equal to the adjusted book balance. Now let's take a look at the proof of cash. We have the beginning May $9,800 for bank and books. we added all the cash receipts, 15,300. We looked at all the cash deposits that we have on the books, minus the disbursement bank and books, and we find out that the ending balance is 12,950 and the books 12,500. The first thing we look at is the receipts. It looks like we had a $500 in the bank that's not on the books, minus 500. And from a disbursement perspective, it looks like the bank took out an additional $50 that we don't have it on the books. Now what we do is we investigate those amounts. So the 500 receipts was deposited, which is good, but not recorded in the books. It's an omission. Why was it an omission? I don't know. Someone deposited the money, but we never debited cash and credited. Maybe if it's client paid their balance or whatever, why did we receive this $500? So we have to fix this $500. Now we figure it out from the proof of cash. And also the $50 is what we find out is the bank took an additional $50 in error. An error means what? It means by mistake, and as a result we have $50 less of cash. Now we'll let the bank know, we would let the bank know what's happening, and that they need to credit back our $50. So the proof of cash reconciles the flow of activity, receipts and disbursement, and detect any discrepancies that might not appear. So usually when there is an error, this is when you have to do a proof of cash or an extended bank reconciliation. They're time consuming, frankly, but this is when you suspect there is an error, or in our situation we're assuming fraud is taking place. A third tool that we have is interbank transfer and detect kiting. This happens when a company will have accounts at bank A and accounts at bank B. And what you can do, if you have accounts at two different banks, you can transfer the money. For example, I can transfer money from my Schwab bank account to my Wells Fargo, or from my Wells Fargo to my Schwab. That's normal. That's always the case. So when companies have more than one bank account, cash can be moved for legitimate reason. Sometimes fraudsters use interbank to create extra cash that does not really exist, and this is what we have to find out. This process is called kiting. What's kiting is when someone moves money from bank A to bank B, that's fine, and properly record the timing of the transaction. What does that mean? It means they move the money. When they move the money, they did not say they moved the money from bank A, but they said it's in bank B. So they did not move the money out of bank A, but they put it in bank B. So it's still appearing in bank A, and now it's appearing in bank B. So it's appearing in two different places at the same time. For example, a classic example will be on December 31st, someone wrote a check for $50,000 on bank A and deposited it in bank B. So they took $50,000 from bank A, put the money in bank B. They record the deposit in bank B right away. Now bank B shows a $50,000 cash deposit, but they did not do the recording until January 3rd for bank A. Remember, the money went out of bank A in December. They did not record that transfer until this January. So as of December 31st, you have $50,000 in bank A and $50,000 in bank B. This is called kiting, having the money in two different places. This is what kiting is. So the 50K is here and the 50K is appearing there. At the end, it looks like the company has $50,000 cash, then it surely does. For example, if they deposited the money, if they withdrew the money on December 29th, 30th, 31st, that's fine, as long as it's in the same period. But you cannot, make the withdrawal, deposit the money, and don't record the withdrawal until the next period. They have to be in the same period. So this ploy inflates the cash balance and can fool investors, lender, or auditors if they're not watching the timing. Does this happen in the real world? Yes, it does. This is a recent case similar to a check kiting. It is a form of check kiting, basically having the money in more than one place. So this was on TikTok last week. Video surfaced showing people taking advantage of a glitch in Chase Bank system. It's a glitch, nevertheless. The substance is the same. It allowed Chase Bank members to write a check for more money that they had deposit the check via an ATM, and then withdraw the funds in cash. So basically you're showing that you have more money than you actually have. It's a form of check kiting. That's basically what it is. Now obviously Chase catch up on this, and they fix the glitch, obviously. Another notable example from the real world, if you're interested in reading about check kiting, just that it exists. Former CEO of Long Island Synergy brand convinced of $1 billion check kiting scheme. What does that mean? It means you write checks that you don't have the money, you deposit the checks, it shows that you have inflated amount of money, and you keep playing this game until you are basically caught. How auditors should spot check kiting or simply kiting. Auditor will prepare an interbank transfer schedule, and maybe I will work an exercise showing you how it works. The amount and date of every transaction between accounts near the end of the period, when the transfer was recorded in the books for both accounts. So in the books it should be basically the same day. It's because you're depositing the money, you're taking the money from one account into the other. On the books it should be done practically the same day or the following day when the transfer cleared the bank. So when the transfer cleared the bank, when did it clear the bank? The goal is to make sure that both the withdrawal and the deposit are recorded in the same accounting period. If there is a mismatch, it could signal a kiting. Again, we'll work an example just to show you how it works, but you want to look at the dates. When was it taken out and when was it deposited in the other account? Let's take a look at this multiple choice question from farhatlectures.com. Which of the following statement would an auditor identify by performing a proof of cash? So when you perform a proof of cash, what can you identify? And as I mentioned in the lecture, we used to do that when there's an error, but basically it could also be used when there's fraud. D, checks written for an incorrect amount. Well, if the check is written, if it's for the incorrect amount, the proof of cash does not catch it. Why? This is an easy tempted. The reason I started with this because it says incorrect amount. You might say, oh, proof of cash, we're trying to prove cash. It's an incorrect amount. Proof of cash doesn't solve this. If the person writing the check supposed to be for $267 and the person wrote $276, the check will clear for $276. As far as you're concerned, the incorrect amount, it's a different problem, but it did clear the check for $276, and the proof of cash would show it's cleared, so it doesn't catch that. Deposit of an improper amount of cash. Again, what's improper? You made the deposit. The proof of cash will show you exactly how much you deposited. It doesn't tell you whether it's proper or improper. What does improper mean? What does it mean? It doesn't catch that. Checks issued to invalid suppliers. When you do a proof of cash, you're not looking for you're not examining every check. If you're doing extended bank reconciliation, you might go and look at every check. Let's look at A. By process of elimination, A is the correct answer. Cash receipts recorded in the books for an amount different than that on the bank. Well, that's a mistake. That's a mistake. Because why? Because you wrote 267, but you wrote the check for 276. So notice on the books, it's 267, and the actual check is 276. Proof of cash will catch that. But if it's supposed to be for 267, but you wrote a check for 276, and it's recorded both on the books and on the checks for 276, it's for an incorrect amount. If they're both the same, even though it's incorrect, it doesn't catch it. But if it's recorded differently on the books and on the bank, a proof of cash will catch it. And those are, again, time-consuming errors, especially when you're dealing with 300, 400, 500 checks written, and you have to go through each check separately. Now, luckily, you could use Excel, but now you could use AI or some form of data analysis to go through this real quick, luckily. For example, what used to take 5 hours or 3 hours or 2 hours, and sometimes you would have to bother your coworker because you are sick of looking at these checks to take a look at them for you. Now AI, I'm assuming, can do it for you. What should you do now? Go to Farhat Lectures, look at additional multiple choice. Lectures, true, false, lessons that's going to help you whether you are studying for your CPA exam or taking an accounting course, auditing course. Invest in yourself. That's the best investment you can make. Good luck, study hard, and of course, stay safe.